that thought right now because we want to introduce a couple of guests to talk specifically about oil and see if that can provide the direction for the market's move here.
Yeah, with us now is Breitling Oil CEO Chris Faulkner and the Short Report's Stephen Short. Guys, welcome. Stephen, how low do you think crude WTI ends up going?
Right now, we're already too low at that $80, $81 for WTI. So if we don't hold here, and I'm really skeptical we can hold here, I think we could get down to that next tranche, that $75 level. We simply have a situation at this point of the year where we do not have enough demand, and that is demand with concern of economic growth. The IMF continues to downgrade the situation in Europe. This is translated into a strong dollar, which is bearish for crude oil. We've already alluded it to before with regard to the equity markets. There's a strong positive correlation with oil. So a fall in the equity market will weigh on oil prices. Yesterday, the IEA for 2009 came down, downgraded oil demand to the lowest low since 2009, i.e. the nadir of the Great Recession. And let's not discount Ebola. If we saw something like this with regard to SARS 10 years ago, we saw a 30% decline in jet fuel prices on SARS. In the 1990s, we saw a 20% decline in jet fuel prices because of the avian bird flu situation. So demand is extremely weak right now.
But you're still saying the price is too low, Stephen? That's your point, is that where we are now you think is overdone relative to where the price of crude should be? Am I hearing you right?
Well, absolutely, because we're looking at a situation now where oil prices for most of the OPEC nations, Saudi included, is now lower than they need to keep their books balanced.
Okay,
here
Chris
in North
Faulkner,
America,
I just want to get Chris Faulkner from Breitling Oil in here now. Chris, do you agree that this move is overdone in oil prices, or do you think it could have further to fall?
Well, look, I think 2 weeks ago we talked about oil testing 85, then testing 80. Both those things occurred. I think there's a floor definitely and a lot of support at 80. I think we may break through again. We saw this morning briefly to 75. But look, as a producer, where we're at today begins to scare me. There are uneconomical areas in the United States already at 85 and below, the Bakken being one with the transportation challenge. I hope oil stabilizes here. It moves up. All the things that the other guests spoke about are true. And we've got challenge with U.S. oil production. The reality is what's happening right now is Saudi and the U.S. are two freight trains heading down the same track toward one another, neither one wanting to put the brakes on. In this case, the brakes on production. Okay, so on November the 27th, when you're having turkey dinner and watching the Dallas Cowboys win, they're going to be fighting at OPEC over who's going to cut production and if they're going to. But Saudi may want to keep these numbers at 80. Why?
And to be clear,
yeah, go ahead.
Chris, you just said the Bakken is already uneconomic. I mean, you're talking about affecting one of the one of the strongest parts of the U.S. economy. Can you get a little more specific?
The Bakken is a pretty expensive area to lift oil from. So certain areas of Bakken, we spend about $60 to lift the price of a barrel of oil out of the ground, plus transportation of crude by rail can be $10 to $12 more. Now, keep in mind, this is not the break-even business, so bankers are going to get concerned if the price of oil begins to get near, $65, $70, $75. So at 85, a lot of folks say, look, the Bakken is getting a challenging area. Now, areas like the Permian Basin, we can still make money, but folks get worried in these areas. Now, if we get to $70, for example, I bet the production in this country begins to curb near 50%. Rigs will lay down, oil will stay in the ground, and that's a challenge. And Saudi knows that. They want to be able to slow down American oil boom so they keep their market share and their #1 position in the world. And that's what they may do come November the 27th. They may say, no, we're not going to cut production. We'll dig into our $750 billion foreign exchange reserve. We'll keep oil at 80. We can make up our budget numbers by pulling money out of that reserve, $20 billion maybe, and we'll force America to slow down. That's the scenario we're in right now. That is a reality.
Scott?
I think that's a great point. That's a conversation that I've had in the last couple of days with Mark Fisher. He seems to have a similar feeling on it. But, again, in my opinion, where oil is right now and looking at the overall market, the XLE is higher today. You have the favorite names that I like, Concho, EOG, they're all up 4%. So as I was coming in today, playing index and derivatives from the short side, I'm buying back the energy names.
You are. Today you are.
They are. And I think oil has found a bottom. And one of the reasons why is just as I go around and I talk to all the old gents and ladies that I know that traded oil for 25 years with me, everyone's short oil now. Everyone's short oil on the belief that oil's going down to $70.
Well, let's not kid ourselves. I mean, this is a selectively opportunistic market.
Yes.
You just have to be very selective in where your opportunities are.
Yes, sure, for sure. And I think also when you look at the coal names, I know John Najarian had highlighted this, Republicans taking the Senate, that potentially is a favorable thing for coal. I would look at that as well, and coal has been obliterated in this hedge fund liquidation.
Guys, was somebody trying to comment on the panel?
Well, one thing I wanted to say is be careful what you wish for, because we'll pay for this in 2015. If oil continues to slide, this could create a global weakened economy, means less exports, higher unemployment, less spending. So while it may be great for consumers now at the pump, what it could be is a big global issue that we haven't thought about. So it's not a situation we want to be entering 2015 in. So if we can stabilize oil here now, then fine. Most of these areas in the U.S. we can still drill, still produce more oil, and that's fine. And Saudi can keep oil at this price for another couple of years, that's fine as well. But if we drive it down to $70, we're going to see a chaotic situation in America.
We'll leave it right there for now. Thank you both, Chris Faulkner from Breitling, Stephen Schork from the Schork Report. Some pretty significant headlines, Scott.